We'd like to start the afternoon session here in Mitchell, and the afternoon session of session 1 for the online people. Jonathan Gunther's agreed to come in and visit with us about income tax management. If you go inside your 2011 report, inside the back cover on the bottom left, Endorf, Lincoln, and Larson. It's called ELO for Mitchell. Phone number. If you have any questions that you'd like to visit John about that he doesn't explain here or online report or something concerning the question. So John, we'll turn it over to you. Thank you.
Thank you. I didn't know you want me or the screen or what you want.
I'll be flipping.
Sounds good. I got a couple slides here, and I got to kind of look and see what we've got here. The first one I've got, and it's probably in your book too, is just kind of a brief about ELO, so we don't need to go real deep into that. There are a number of farm or accountants, CPAs in the office that do a lot of farm income tax work, so we feel we've got a pretty good farm tax team put together. If I don't know something, there's somebody else in the office that does. So
I hate to bother you, and I failed to do this.
Nope, no problem.
Can you turn a reminder? This PowerPoint presentation, session 1, page 1. It's all laid out there for you, so you can write notes right as you go along with John's presentation.
And there are probably a few changes, because I think you had printed it before I sent you the updated one. You can thank your local congressman for that, because they changed stuff after we got done. So this is just a real brief overview on me. I do a lot of various items in the office. Because of my background growing up on the farm, I grew up on a farm by Stickney. Because of that, I've kind of stepped in to try and become the agricultural expert in our office. I won't say I am yet, but I'm getting there. So that's why you're stuck with me today. The first few slides are just a little bit on benefits of record keeping, which I know is part of the reason you're in here, is to go through the record keeping options with the guys that you work with. A few benefits for you: monitors your progress, helps you prepare your financial statements, which the banker's always asking for, it seems like. So helps you identify receipts and keep track of expenses. It also helps with us to prepare your return. Now in our office and a lot of tax offices, we don't audit the information you give us. So if there were ever an IRS auditor to come in and look at something, you're going to rely on the records that you had kept, that you gave us the numbers for, because we're not going through an auditing. We typically take the numbers that you guys give us, and that's what we use. So it's good to have it for support, to support the numbers on your return. A few other things: tax planning. Our office feels the definition of tax planning is to plan wisely and prudently to pay a fair share of taxes, but not more than what's rightfully owed, not more than we think you should owe. And it's kind of a fine line, because it's hard for me to say you should pay how much in taxes. It's what the client feels comfortable with. It's what you feel comfortable with. We do feel that everybody should pay a little bit, but I mean, we work with that as well. The objective of tax planning is actually to reduce the effective tax rate in order to generate after-tax dollars for any goals you may have: purchasing land, purchasing equipment, paying off debt, that type of item. This is kind of our perspective, our office perspective on tax planning and taxes in general. We feel taxes are a cost of doing business. It should be a consideration in business deductions and business decisions, but it should not be the only consideration. If you're going and spending $200,000 for fertilizer on December 31st just to avoid taxes, then we're probably going to have a few conversations. And, you know, I mean, spending money on fertilizer in December makes sense sometimes, but it kind of depends on the amount and that type of thing. And if your only reason to do it is to save taxes, it may not be the best idea. A couple other quick things on tax planning. We feel it should be comprehensive. It should encumber income taxes, self-employment taxes, and if you're getting to the point where you're discussing estate taxes, getting out, that type of thing, it should cover that as well. A lot of our tax plans, and this year was a weird year, which I'll kind of get into with some of the tax law changes, but it was a weird year this year because we had people in 2 or 3 times doing tax planning, and then Congress changed a whole bunch of stuff right after the first of the year, and some of our tax plans aren't going to matter. So it's been a weird year for that. We feel it should be in advance. We have gotten to the point in our office where we actually send out appointment letters just like we do for tax returns to get people in November and possibly the first part of December, because the more time you've got to make an informed decision, the more time it gives you to be able to execute that plan. We feel you should be a planner, not a responder. So, and then there's a quote from Churchill on there too, which is kind of the same concept. A few strategies with tax planning. The four main that I think there actually is a few more on the next slide, but this is kind of the jumping off point. Timing, shifting, investing, and the use of tax laws. That's kind of what we look at. Can we defer crop insurance, or can we defer a payment on grain sale, or can we defer payment on cattle, or something along that lines? Shifting and splitting. Can I use a couple of entities to shift it? Can I pay my children wages? And we'll talk about some of these options in further on in the presentation. But there's just items you can do, because there's a lot of parents that pay their children, because if you can pay up to $5,950 for 2012, and it's going to be pretty close to that so we'll say $6,000 for 2013. You can pay your kids $6,000. They don't have to pay any tax on it, and it's a $6,000 deduction to you. So it's options like that. Investments, we don't use a whole lot of investing other than probably 1031 exchanges, like-kind exchanges for land and that type of stuff. And then just what are the tax law provisions? What's out there, what's available that we're not using? Is there certain deductions that we should be taking that we're not, or is there more depreciation that we can take, that type of item. And then this is actually the part that's probably different than what you've got in your binders, because this has changed, and I changed the presentation. I actually borrowed one of our other CPAs, had done some stuff to change the presentation a little bit. There's a few items that were set to expire for 2011 that have come back. There's some that were set to expire in 2012 that have come back. The frustrating part was that Congress did it on January 3rd of 2013. So the two main ones that will affect probably the majority of the farmers and ranchers and whatnot is depreciation. Bonus depreciation was set to expire for 100% bonus was set to expire for 2011. They were keeping 50% for 2012. They have now extended 50% for 2013. The Section 179 limit was set at $500,000 in 2011. You could write off $500,000 of equipment, grain bins, those cattle, those types of items. That was set to go to $139,000 for 2012. It has been extended now, and they're keeping it at $500,000. The $500,000 number wasn't affecting as many people as the phase-out limit was affecting people. When it had gone back down to $139,000, once your purchases hit $560,000, you started to lose dollar for dollar on that 179. That's where we were hitting more people than we were with actually losing the 179 limit. But that phase-out limit is back up to $2 million now, and then the write-off is up to $500,000, and that has been extended through 2013 as well. State and local taxes, the education deductions, and the qualified charitable distributions, I'm going to skip over just because I don't think they're going to affect a whole lot of people. Most of them are, the state and local tax deductions is for itemized people. The one that may actually affect some people is the charitable deductions, but that's only on the required minimum distributions, and you have to be over 70.5 for that to affect you. So I'm going to skip that for now too. So now these are some provisions that were set to expire at the end of 2012. One that did expire and that Congress did allow it to expire, it was actually the only tax raise that they actually had in this whole bill, other than the high income earners. But it was the 2% payroll tax deduction, or for farmers, the 2% less on self-employment tax. That did expire. So if you're earning a wage, if you're farming, if you're earning a wage and farming, you'll see that your paycheck probably went down unless you got a big raise. The other part you'll notice is that when it comes time to file next year, you'll have to pay 15.3% self-employment tax instead of the 13.3% it's been for the last 2 years. itemized deductions and personal exemptions. They phase out for high adjusted gross incomes. That number is defined at 250 to 300,000. What's really weird is this bill that they just passed has high income defined as about 4 different numbers. So earned income tax credit, child tax credit, American Opportunity Credit, those are all extended through 2013 now. They were set to expire after 12. The one that hits a lot of people is the child tax credit. That was supposed to go from $1,000 to $500 per child. That has been extended through 2013 or 2017, excuse me. Student loan interest, that one was kind of a weird one. You're actually only supposed to be able to deduct your student loans through 60 months. Well, student loans go a lot longer than that. And so they've extended that one permanently. You can deduct student loan interest as long as you pay it. And the marriage penalty was actually a reduction of standard deduction for married couples. The way it's been for the last probably 10 years is a single standard deduction was, we'll say, I can't remember the exact numbers, I think it's 5,700. Well, for married filing jointly, it was double of that. With this marriage penalty, it was actually only about a third higher than that, so you were actually being penalized for being married. That's why they called it the marriage penalty. That has been extended, and I'm not sure if it's been permanently extended or just for a few years. A few others. Tax brackets. Actually, the new tax law, we didn't know what tax brackets were going to do. We thought they were going to go up. It actually changed that the bottom tax brackets are all staying the same. The only thing they changed was for high income earners, which in this case they define as 400,000 for single, 450,000 for married filing jointly. They've added a 39.6% bracket. The top bracket before was 35. So they've added this additional bracket for these high income earners. And that was actually what was holding the whole bill up and screwed everything up, was because they couldn't agree on what a high income earner was. So that was what kind of screwed that up. The other one that actually has made will make a lot of effect and made a lot of effect on people's decisions is the capital gains rates. It was set to expire at the end of 2012, but they have kept it. And in this case, what they have done is the maximum capital gains rate is if your income is under $400,000 for a single or $450,000 for married filing jointly, the maximum capital gains rate is 15%. If you are in the 15% tax bracket, which for married filing jointly is roughly $70,000, there is no capital gains rate. It is zero. And they kept that. We were kind of surprised that they were going to keep that. If you're over the 400 or 450, it goes to 20%. But for everybody that's under that, it's going to max at 15 and will be zero through the 15% tax bracket. So that's one of the changes they made that we were actually somewhat surprised by. The Section 179 I had already talked about. It's set to go back to $500,000 for 2012 and 2013, and they have kept the 50% bonus through 2013 as well. A couple of things that will affect you in 2013. Wait for it to make sure it gets through there. The biggest one is probably the new Medicare tax. And this is also for high income earners. This was actually, put into effect with Obamacare. And what it is if your income, if your adjusted gross income, if you're married, is over $250,000 or $200,000 if you're single, any unearned income will be subject to a 3.8%, additional 3.8% tax. Now where this comes into effect is our farmers who are looking at getting out, because land rent is considered an unearned income, interest is considered unearned income, and if they're not actively farming, capital gains are considered unearned income. So if they decide to quit, no longer actively farming, and start selling off equipment, if they sell off enough of it in a year that bumps their income up, they're going to have this additional 3.8% tax. Now I should say the additional 3.8% is on the difference between, I don't know if it's on this, yeah, it's on the excess of the modified adjusted gross income or the net investment income. It's whichever is higher. So if your total income is $300,000, but investment income of that is, the tax would only be on the $50,000. So it's not as big a number as some of the people had made it come out to be, but it still is will come into play because people start selling land. It's I mean, you're talking pretty big numbers right away. So that's a quick summary of how it's calculated. I'm not going to go into it because it's something that will come into effect in 2013. This is kind of stating what a few of what a net investment income is. And like I said, I borrowed this, so there's some that may not be quite as applicable as that's why I'm jumping through some of it in a hurry. The one other thing to mention is estate and trusts are subject to that tax if you're running into some estate tax filings and that type of stuff. And finally, this is actually just kind of a recap. And I can email this out to you, Roger, if we need to get it to somebody, because I'm not going to go into a lot of detail on this because it's basically saying what I had already just told you about most of the changes. The couple of things that I didn't cover earlier, probably the biggest one is the permanent AMT patch, which is right here. That one was kind of interesting because they put in this AMT. AMT is kind of a funny beast in and of itself, and they've always annually extended the patch for it. Well, the number is actually fairly low. And for most people, like for my wife and I had done a calculation on it. We were going to owe an additional $2,000 in 2012 because they hadn't changed this tax yet, on top of what we had already had withheld from our paychecks. Just because of the fact that it drops the income so low, it was going to affect everybody. So they have now permanently extended that AMT patch so that we can plan for not having it there basically, except for our higher income earners. So that was one of the things that was kind of nice is they've done it permanently inflation adjusted so that we don't have to worry about it in the future. Everything else there we have kind of already discussed, so I'm going to jump to the next slide. It also permanently extended the $1,000 child tax credit, which, like I said, was kind of a big deal because, like, for me, that's another $1,500 in taxes because I have 3 kids. It's another $1,500 credit that I get. It also extended the refundable portion through 2017 because that also made a difference. So everything else we've kind of discussed except for the estate taxes, which is on the next slide, so I'm going to jump to that. First off, just for some planning for some of you, if you're working with somebody else or even if you're looking at getting out, you can gift annually. For 2012, it was $13,000. For 2013, you can gift $14,000 a year, tax-free, no estate taxes, or no gift tax required. It's just a gift. And actually, a mother and father can each gift $14,000 to each child and children's spouses. So you can gift away quite a bit without ever having to file a return. So that's the annual gifting side of it. This is what changed with the American Taxpayer Relief Act, I believe is what they called it. There was some concerns with the states and also the lifetime maximum gift. We didn't know for sure what they were going to do with the estate taxes. Estate taxes were set to actually go back to $1 million at 55%. The exemption was $1 million. They have kept it at $5 million annually adjusted for inflation. I believe for 2013 it's $5.25 million, and the rate is going to go to 40%, which must be on the next slide. The other thing that they did was extended the they kept the lifetime gifting at $5 million. We have done more gift tax returns in the last month than we probably have done in the last 3 years, just because of people trying to avoid those issues. But that as land continues to increase in value, that's where we continue to see the concerns. People that did a bunch of gifts this last year just because they didn't know what was going to happen, they're still probably okay because they've frozen their estate. They've gotten a bunch of it out of a bunch of assets that'll appreciate out of their estate. So,
how does that work for the person that receives the gift?
Nothing. No concerns there whatsoever. Anytime you get a gift or an inheritance, it is not taxable. So from that standpoint, for this crowd, that's probably a little bit more of their concern is receiving the gift. But yeah, and even if you're having the conversations, if somebody's wanting to gift to you, there are no concerns from that standpoint because a gift is not taxable to you when you receive it. Yeah.
That 14,000, does that have to be to a direct relative?
No, you can give it to anybody. And you can give, like I said, if you wanted to give it to, if you and your wife both wanted to give it to, we'll just say 2 people to start with, you can give them 14, your wife can give them 14, you could give their spouse 14, your wife could give their spouse 14, you can get to 50,000 pretty quick, just with 2 people. So that doesn't ever touch your lifetime gift, and it also does not require any sort of return. So
That doesn't go against your 500?
nope, that does not go against the $500,000 or the $5 million. And the other thing I should mention is the lifetime gift of $5 million. If you do that now, you've used up your exemption for when you die and your estate is closed. So if you, let's say your estate's worth $7 million. Now there's a couple of different things that also apply with spouses. They kept what's called portability. If your estate's worth $4 and you pass away and you give everything to your spouse, she actually gets an extra $1 million because you only used up 4 of your 5. So the $1 million that you didn't use transfers to them, so she's got 6, which is a nice deal for assets that are going to appreciate, like land at this point, because we don't see land going down at any point right now. So
you give somebody money, you give somebody that $14,000,
you don't have to do anything, just write them a check and put, like for 2013, if you want to write them a check for $14,000, put in the memo, put 2013 annual gift, and that's all you have to do. You don't have to file any sort of form at all.
and that affects your taxes and.
Not at all. It just gets, what it does is it gets the asset out of your estate. It gets the land out of your estate. Some people do it with partnership interests. If they're putting land into a family limited partnership and then they gift away so many partnership units every year that are valued at around that $10,000 to $12,000, they just write up the form that we're gifting this to you at this point. The value on this is this.
So you write that off as.
It's not a deduction at all. It just gets it out of your estate. Yep. It's not a deduction. There really is no tax implications to it at all, other than it's getting some of that out of your estate when they have to file the estate tax return. So, yeah.
I had a couple quick questions here before we get too far.
Sure.
On the 179 tax depreciation.
Yep.
That was $139,000 for 2012.
Right.
And they decided to go back to 500.
They retroactively made it 500,000.
Because they were initially going to go down lower, weren't they?
Yeah, because 2013 was set to go to 25,000. Of inflated for adjustment, it was going to be around 40.
Okay.
But the other side of that was your purchases were going to phase out, and it was going to be around 150,000 when your purchases phased out. So you go buy one tractor or a combine, you've pretty much used up your opportunity to take anything.
Yeah.
So they have retroactively reinstated it for 2012 and for 2013. So it's kind of frustrating because we had actually gotten some people talked into paying a little bit more tax just because of the fact that these tax laws were set this way, and we have a feeling the conversations are going to change when people come in to do their taxes now. So it's frustrating that Congress couldn't get anything done. I mean, I don't have any problem with people taking the write-off. I just wish we would have been able to plan for it. So.
And what was the bonus depreciation?
Bonus is anything that you purchase new, you can automatically, as long as the useful life on it is less than 20 years or less, you can automatically write off 50% of it. It was at 100 through 2011. It's now 50. Where we saw it, the best benefit in that was actually pole sheds, because they're considered 20-year property for farmers. We had a lot of farmers that constructed pole sheds in 2010 and wrote the whole thing off because it was new. So that was the biggest benefit we saw to it. Now you can still write off half of it, but that was probably the biggest benefit to that bonus.
It wasn't just a pole shed, it was any shed.
It was any shed on the farm.
Shop,
Yep,
whatever.
shop, yep, anything on the
Yeah,
farm.
I worked with a guy, finally built his dream shop of $265,000.
Wrote the whole thing off, I'm guessing. Yep, we had a few that did that. What's really interesting is farmers were really the only ones who were able to take advantage of that. We had actually, it was two clients. It was a father and a son, or father and son-in-law. They both built the exact same building. The son-in-law was farming, and the father ran a plumbing business or something like that. The father's was 39-year property that he has to depreciate over the next 39 years. The son-in-law wrote all his off in the year he built it. So it's a thing that farmers got that nobody else got, and it's still available. You can still take half of it. So
Gifting grain out of the field,
gifting it,
yeah,
okay.
are you gonna talk about that?
You're talking like charitable contributions? Yes, I do have a slide on that.
Alright.
So a little bit later here. So yeah, I will cover that. So. These aren't really tax law changes, it's just a few other agricultural related items. We're starting to see a few more issues with FSA regarding direct payments and eligibility for direct payments. We're seeing a few more letters on certifying their AGI. It kind of depends on how the entities are set up or how they're farming, because we have some farmers who have split their farm now. They do 2 Schedule Fs, one for the wife, one for the husband. And primarily the reason for that is so that they can have 2 program payment limits for gross income purposes. So, energy credits and the grants, they're still available. We aren't seeing a whole lot of those anymore. The other one on this slide that I actually would like to actually comment on is the bottom bullet point. The IRS converts 2 farm proprietorships into a partnership. This was actually a tax court case out of, I want to say Washington State. It was a father and a son that farmed together. The father was also a CPA. He had a pretty successful CPA practice. And so what they did was they farmed together. They had a couple things that said such and such farm partnership. Their bank account said such and such farm partnership. And what they were doing was the son was getting 100% of the income and the father was getting like 70% of the deductions, because he needed more deductions to offset his CPA practice. The IRS came in and said, no, this is a partnership, you have to split it however, according to the partnership agreement, and he ended up paying a lot of extra tax and penalties, and he actually might have faced some criminal charges because he was a CPA. I guess the comment I'm making, or point I'm trying to make with it, is we have a lot of people that are 2 brothers farming together, or dad and son are farming together. It's an informal partnership. The biggest concern that we see out of it is the Section 179 limits, just because they've been so high that the IRS could possibly come back in and say, well, actually, you 2 were farming together, you only got 1 Section 179 limit, and they disallow some of those limits or some of those deductions. We haven't seen anything with it yet. We haven't heard anything about it other than the couple of the newsletters that I receive have talked about it, but it's just something to be aware of. If you're farming with somebody else, that's probably the biggest one, is if you're farming with somebody else, if you don't want to file a partnership return, if you don't want to be considered a partnership, don't set up bank accounts that say farm partnership. Don't get EINs that say farm partnership. If you really want to do it, make sure you're following the rules and splitting everything 50-50, writing checks back and forth, splitting checks, because otherwise you run the risk of the IRS coming in and saying, this is really a partnership. And they may disallow some depreciation. That's the biggest place we see it, is depreciation. So, a few definitions, I guess, and this is from the standpoint of the IRS. Qualified farmer. In the IRS's eyes, a qualified farmer is anybody who receives 2/3 of their current or previous year's gross income from farming. Now, that takes all your grain sales, all your cattle sales, all your program payments, all that type of stuff. And if that is more than 2/3 of any of your other income, you're considered a qualified farmer from the IRS's standpoint. Now, the reason that that's important is because farmers do get a few tax breaks. Like I said, for instance, the pole sheds or the shops and that type of thing, it's 20-year property for farmers. The other thing that you get, and probably the most important one, is file your return by March 1st and you don't have to make estimates. Anybody else who runs a business, a sole proprietorship or anything like that, the partners in our office at ELO, they all have to make quarterly estimates. They have to quarterly have to make a payment with the IRS, kind of figure what they think their tax is going to be and make that payment. And farmers can do that as well. However, because they're considered qualified farmers, they get this option to file by March 1st and pay everything when it's due. The thought process is typically farmers sell their grain after the first of the year or in the spring. They've been contracting, and that's when they have the cash to pay the tax if there's any tax due. That's the reason it's there. The other thing that farmers actually can do is you can make a one-time payment in January, by January 15th as a estimate, and then you don't have to file till April 15th. But the majority, I would say 95 to 98% of our farmers are filing by March 1st and paying, if anything's due, paying by March 1st. The one issue that we see with that this year is that the IRS has delayed filing. Some of the forms that they've delayed are forms that farmers will need to file. And so we're not exactly sure how that's going to work this year, just because we may not be able to file the return by March 1st, and the IRS has not given any guidance as to what they're going to do. At this point, our office has decided at this point that they will probably figure everything out, figure what we think the tax will be, and have a payment voucher sent in on March 1st, and then file the return when it's available. That's been kind of our thought process, and that may change too. The IRS may change their mind and change something, so it just kind of depends a little bit. Accounting methods for farmers, typical accounting methods, most farmers are on the cash method. Income is included when you get it. Expenses are deducted when you pay it. There is the accrual method. Most farmers, agribusinesses do not use the accrual method. There are some situations where they may be required to, but that's more at the corporate and farming syndicate level, not our individual farmers and family farms. So the one thing I will mention, and I think it comes up again with the cash method, is constructive receipt. In the eyes of the IRS, if you've got the check and you just didn't cash it, that is not receiving the income. That is not deferring the income. That actually is in the income in the year you got it. So if you've got a check sitting on the dresser that you got in December and just chose not to cash it, it still actually is income for 2012 or that year. Most of the time, and you'll probably notice it when you go to sign a contract with the elevator or sale barn or anything like that, they'll make, or if you want to defer it, they'll make you sign a contract. That's the reason, because you've avoided that constructive receipt. If it's available to you, the IRS will say it was yours at that time, and it should have been income at that time. Now, what's kind of goofy about that is it's really just moving it from year to year, so it may not make a whole lot of difference, but that's their thought process. So this slide I'm actually going to fly through pretty quick. It's sales of farm products. Just kind of shows you where stuff show up on the Schedule F, which is the farm schedule, or if it shows up on the 4797, which is either ordinary income or capital gains. Basically, if you sell any farm equipment, any buildings, any land, or any cattle, hogs, chickens, anything like that that you had held for breeding purposes, those all go on the Schedule 4797, either capital gains or subject to depreciation recapture. They are not subject to self-employment tax. That's the big kicker right there. Is if you buy a tractor, write the whole thing off, and sell it 3 years later, the income you receive from selling it 3 years later is not subject to self-employment tax. So it's kind of an interesting concept because you've got to deduct it to reduce your self-employment tax, but it's not subject to it if you sell it. So some types of income, and I think there's a few different slides on this. Cooperative distributions. We're starting to see more and more 1099s coming out of various places and various items. Basically, it includes the cash you received plus the stated dollar value of any written notice allocation. You'll notice that wheat growers, CHS, a lot of your local co-ops, you'll get a check, but then you'll get a 1099 at the end of the year that has a completely different number than the check you got. Basically, you got a cash portion, they allocated part of it to equity. You get to pay tax on all of it now, and then when you get it back, when you retire, pass away, whatever it is, then it is non-taxable to you. So, the taxable portion should not include any personal or family items. Typically, we don't get too worked up about that because it's typically a minimal dollar amount. If you're throwing a little bit of gas in your personal vehicle or your off-farm vehicle, we're probably not going to get too worked up about it. The other comment is the non-qualified patronage dividends. Wheat Growers has been doing this for the last couple of years. You'll get a notice that says we allocated so much to your equity, but it's a non-qualified dividend. You don't pay tax on it now, you pay tax on it when you get it, which may make it an accounting nightmare when you do finally get it. Because typically it's 20 or 30 years later and nobody remembers that it was never taxed in the first place. So, capital credits, taxable portion, basically for that portion of it from utility companies, a lot of our farm clients, actually most of our farm clients, we do not take 100% of the utilities, so you technically do not have to report 100% of the capital credit. It's whatever portion you deduct. So, program payments, I'm not going to go real deep into program payments just because you guys probably understand them better than I do. There's various amounts of program payments plus CRP. The only comment the two comments I'll make, if you have to pay any back, it's just deducted as an expense. If the amount of income you received is different from your 1099, we'd probably gross it up and take an expense. The other comment I'll make is CRP. If you're actively farming, your CRP needs to go on your Schedule F and subject to self-employment tax. If you're not actively farming or retired, it probably is not subject to self-employment tax. We're not really sure why that's such a big issue for the IRS, but it is for some reason. They've been watching that for the last few years. Actually, there was an office out of Fargo that sent a whole bunch of notices out a couple of years ago that got fought. But for some reason, that CRP number, they're looking at that, trying to collect as much self-employment on that as they can. Cost sharing, has anybody done any cost sharing for improvements, dugouts, land improvements, anything like that? If not, I'm going to jump over it. We don't see a whole lot of it anymore. Next question is CCC loans. Anybody using CCC loans anymore? I'm probably just going to skip over that too then, because the last probably 5 to 6 years we haven't seen hardly any. The only thing I'll say is you can use two methods. There's the loan method or the income method. You can elect either one at either time if you do start to use them. So, crop insurance. That's been a fun topic over the last 3 to 4 months. Farmers get the unique opportunity to postponing reporting of crop insurance. Now, there's a few rules you do have to follow. You have to be on the cash method of accounting. It has to be your normal business practice to sell more than half of your crop in the following year. And then you have to make a statement on the return. And the election is very simple. It's basically we choose to defer our crop insurance till next year. There are a few other things you have to put on there. You have to put the type of crop, you have to put the type of payment, the reason for the disaster or whatever. The other interesting part about it is you can either make it on the original filing, or you can go back and amend it and choose to defer it on an amended filing. The other couple of odd items with it is if you have more than two or more specific crops, the deferral covers everything. So this year, if you were struck by the drought, if you got paid on corn and beans, you have to defer both your corn and your beans. You cannot choose one crop and not the other. You must also defer any USDA disaster payments. And if you don't receive, say for instance, you didn't receive your check until January for last year's crop, you've already basically deferred it. So you can't defer it another year. The other couple of things with crop insurance, the more than 50% rule, that has to be over all of your crops. So if you typically sell all of your beans out of the field and you typically hold all of your corn, as long as the dollar amount of the corn is more than the beans, you're probably okay. But you do have to hit that more than half of your crop in the following year. And then the real hot button item that we've had with this year's is revenue protection versus yield protection. We have come to learn most policies are a hybrid of yield and price. And then also, most policies this year had the option for a harvest price option. With those, if you were paid entirely on price loss, it is not deferrable. An example of this would be if, for instance, your guaranteed yield was 100 bushels an acre. You hit that, but the price tanked, and the guaranteed price when you signed up, let's say, was $5.50. Price at harvest time was $3. You're going to get paid on that difference to make up whatever your guarantee per acre was based on that price loss. That is not deferrable. However, the harvest price option is a completely separate concept, and we feel is deferrable. We feel if you had the harvest price option, it is deferrable because you were paid on the fact that you paid a little bit extra to have the option to take either the base price or the average of the October price. So because of that, it was not a payout based on the fact that the harvest price was lower than what the base price was. You were not being paid on that. You were still being paid on yield loss. It was just that you took that gamble that the harvest price was going to be higher than the base price. Because had the harvest price been lower, you wouldn't have gotten the additional check if you had the harvest price option. So that's kind of our take on it. Any questions on that? I know it's been hashed over by everybody for months already, so. Income due to disasters, there are a couple of options here as well. If you're in a federally declared disaster area, which I want to say 90% of the counties in this area are, there are a couple that weren't, but I can't name them for you off the top of my head. However, if you were in this federally declared disaster area or the contiguous area, if you had to sell off part of your herd because you lost ground, you didn't have any feed, you didn't have any water, whatever, if you had to sell more of your herd than you normally would, that's deferrable. However, it's only deferrable for 2 years. You must replace it within 2 years. You may, and like I said, you can only defer the amount in excess of your normal sales. So if you normally sell 20 head of cattle, but this year you sold 50, you could defer 30 of those head. But you have to buy them back within 2 years. If you don't buy them back within 2 years, you got to pick up the income. The other option that you have is for feeder cattle. Let's say your normal practice is to sell your feeder cattle and sell them as fats in August. You're keeping all your cattle and you sell them in August. This year, because you didn't have any water, you didn't have any feed, whatever, you sold your second crop in December. You can take the money and elect to defer it just like crop insurance. However, you have to be in one of these federally declared disaster areas. So basically, if you sold two sets of herds or two crops of cattle for feeder cattle or fat cattle, you can defer one of them to the following year. So. Commodities, futures, and options, and I'm assuming you're having somebody come in and talk on this later, so I'm going to breeze over it primarily from the tax reporting standpoint. Hedging versus speculation. Hedging gets preferential treatment for farmers. If you're hedging and you lose money, it's a loss on the Schedule F. You make money, it's income on the Schedule F. You must also file the 6781 with the 1099B adjustment, but your preparer should know how to do that. If it's speculation, it is not treated as fairly. If it's a loss, you'll only get to deduct up to $3,000 unless you have a lot of other capital gains. If it's a gain, it gets split 40-60 between long-term and short-term and is taxed at those rates. Long-term capital gains are the ones that get the more preferential rate. That's why part of the reason they split it. But the biggest part of speculation is you do not get to take the entire amount of the loss against your farm income. Now, there are a few rules when it comes to the actual hedging. I don't think I have any of them listed there. Primarily the hedging, though, you know if you're hedging or not. It's got to be to protect a price, to protect a supply, that type of item. If you're running cattle and you've got pork bellies, you're not hedging. Now soy meal, corn meal, those type of items, yes, you probably are, because that falls under the feed, and you can hedge all of those items as well. So, but I don't know who's coming in later, but I'll let them go into more detail on that, because they know it better than I do. But that's the tax side of it. So, installment sales and deferred contracts. Installment sales, typically the most of the time we see installment sales is when it is on sale of land. However, you can do it on inventory as well. It's a little goofy. I don't know that I've seen it in the 8 years I've been doing returns. I don't know that I've seen it. The only other comment with installment sales is you need to make sure you're charging interest. It cannot be an interest-free installment sale. Deferred contracts, this is what I was talking about with the shifting and splitting and the constructive receipt. You need to make sure you're avoiding constructive receipt. We have some people who like to play games and not. There are some people who want the expense in 1 year and want the person they're writing the check to does not want the income in that year. What you need to do then is send it certified on December 31st so that you've got the expense and then they didn't get it until the next year. The IRS follows for farmers on the cash method what's called the mailbox rule. If it wasn't in your mailbox on the end of the year, it's not yours. If it went out of your mailbox on the end of the year, it's an expense. Which is fine for unrelated parties. Where it gets to be a little bit tricky is if you're trying to send mom and dad a rent check and they live a mile from you. That's where it gets a little bit harder to defend. We still have people do it, but it has been under the, this is gonna be hard to defend if the IRS ever comes in and looks at it. Conversation.
Can't you claim whatever, any of the first week of January as well, if you want to, and like, anything that happened the first week of this January, you can claim for 2012?
That I have not been told. I have typically never, I won't say never, but we typically don't recommend it. Like I said, that's not something we follow. We typically follow the, it's gotta be first of the year is first of the year. Now, I'm sure that it happens and I don't hear about it, type of a thing, because people are smart enough to know that I don't want to know that sometimes. So, but from that standpoint, that's another reason why we like to have people in November, because then you already know what you need to do. It's not a, oh shoot, I needed to write that check, I got to go back. You know what I'm saying? The only other thing with deferred contracts that I will mention is you can't have interest on them, and then you also cannot use them as collateral for a loan. We had a guy a couple of years ago who was concerned about an elevator. He ended up taking, I think it was $500,000 worth of grain sales in the year because he didn't know if he was going to get the check the next year, and he couldn't do anything to secure the money. Because a deferred contract is basically an unsecured loan to the elevator. You're in the same position as every other unsecured creditor to them. So that's where the IRS is looking at it from that standpoint as well. So, other incomes, rents and crop shares. Typically, rent farmland is typically included as farmland income or farm income. If you're subleasing some pasture, you don't have any cattle anymore, but you got a little bit of pasture land. You're leasing it, you're subleasing it, whatever. It's rental. Typically, if that's all you're doing is renting, it's not subject to self-employment tax. If you're farming, typically it shows up on the Schedule F, unless it's a big chunk of money. Then we'll have the conversation. Well, is it a true rental, or is it just a little bit of this type of stuff? The other thing with rentals is if you are taking care of cattle, if you're renting land to cattle or land to somebody to run their cattle on, but you're checking them, you're making sure there's water there, you're doing any vaccinations, that is subject to self-employment tax. So that needs to be on Schedule F. Now, if all you're doing is saying there's the pasture, it's 300 miles from my place, you can use it for whatever, so much an acre, that's a true rent, probably not subject to self-employment tax. So, crop shares. Crop shares is just another way for people to rent. It's a way for some people to control how the land is being used, what's planted on the land, the amount of money that's spent on the land. If they're materially participating, if dad's trying to help his kid out, so he's doing it on shares, but he's still out there helping make decisions, he's probably subject to self-employment tax. If all you're doing is saying, I get my cut at the end of the year, you do whatever you want, I get my cut, then it's not subject to self-employment tax. So, A few other types of income, and some of these we tend to gloss over a little bit. Barter income, typically nobody reports any barter income. It happens, we know that, but the IRS is not concerned about it at this point, and we're probably not either unless it's a big number. But typically if it's barter income, it's pretty minimal. Custom hire needs to show up on the Schedule F. If you're custom planting for somebody, if you're custom feeding, any type of that shows up on the Schedule F. Easements and right-of-ways, that's probably the other big one that we see right now. Easements and right-of-ways, there's a couple of different ways you can do it. If it's a temporary use easement or temporary use right-of-way, it's rental income. If it's a long-term or a perpetual, like with the wind farms over by White Lake, there was some easements written over there. They're treated as a sale. You can do a couple of different things with that. You can reduce your basis in the land, or you can pay capital gains on it, or if you have no basis, you have to pay capital gains on it. If it's for damages, if somebody's running a pipeline or a water line or electrical line or something like that, they take out 6 rows of your crop and pay it for damages. That's just like if you sold the crop. So, farm expenses. Farm expenses are the fun ones. Car and truck expenses, typically you have to take a business use. Farmers are allowed or given 75%, no documentation required, you get 75%. And you can either be the standard mileage or the actual costs. We typically don't see a lot of farmers using standard mileage. Typically they're taking actual costs. A lot of times it's because they want to write off the depreciation on the pickup. And then typically the fuel, gas, repairs, and that type of stuff are going into the farm repairs. So we see a lot of people using actual costs. We don't see a lot of standard mileage. If you do use standard mileage, you can only use it for 4 vehicles, 5 or more, and you can't do it anymore. So, what's that?
If you buy a truck to own it, it pays a lot better to use the mileage than using I put on 20,000 miles on the truck.
Right, and it depends a little bit on the mileage that's put on. And how many miles you're running. You know, a lot of the people that I work with, their actual costs, it comes out somewhere between 15 and 18,000 miles is kind of where the break even is. So if you're only running 12 to 15,000 miles, actual costs do a lot better for you. And like I said, most of the time when we're getting them, people are buying a pickup at the end of the year and they need the write-off or want the write-off. So we're taking actual costs to take the depreciation. That's where it kind of comes in from our standpoint. Because if you're buying a $50,000 pickup and you want to write off 75% of it, you're at 35 to 40,000.
Right.
Where if you're at 20,000 for mileage, 50% of that's only a $10,000 deduction.
Yeah, but
so
you can do that every year where I won't bought a $15,000 truck.
Right. In that situation, you're right. If you're going to buy it and you're going to run it, that does make more sense. It really is a case-by-case basis, but like I said, we don't see that many, at least I don't see that many when I'm working with people that are using the standard mileage. So, depreciation, we kind of went through this already, and you can note that these numbers are wrong because I did not go back and fix them for the tax law changes. It's going to be $500,000 for 2012. The phase out is going to begin at $2 million, and I believe the phase out ends at $2.5 million. The one thing to note with Section 179 that I did not mention before is it cannot be from a related party. If you're buying equipment from mom or dad or Uncle John or whoever, you cannot fast write out. You cannot take Section 179 on that. The reason for that is they don't want people buying equipment back and forth every year and just keep writing it off. So that's the reason for it. 50% bonus on anything new and placed in service purchased in 2012. You'll always also get that for 2013. Like I said, we've kind of gone through that already. So certain vehicles are limited to $25,000 for the Section 179 write-off. There is no limit for the bonus except the 50%. However, certain SUVs and trucks with gross weight of 14,000 pounds or less are limited to $25,000. A couple of exceptions. The one that probably hits most farmers is if the box is at least 6 feet long. Your F-150 Chevy 1500 four-door short bed pickup actually should be limited on its depreciation. So this was actually put in place for people who were buying Escalades and H2 Hummers. They were trying to write off $60,000, $70,000 vehicles in their business. That's the reason that this is in there, and that the poundage is in there, just for the purpose they were trying to stop people buying basically luxury vehicles and trying to write them off through their business. That's where the $25,000 limit comes from. Wages for family members. You can pay your spouse and children 18 or older wages. They are subject to federal income tax withholding and Social Security tax withholding. Any child under the age of 18, you can pay tax-free, basically. They are exempt from Social Security, they are exempt from income tax withholding. You can basically just write them a check and it's a deduction to you. You give them a W-2 with one number on it that says we paid you this much, and that's all you have to do. You don't have to file any other forms. Like I said, that's a nice way for parents to shift some money into kids' pockets. Where we see a lot of it is kids going to go to college in the next year or two. We don't want to pay any income tax on it. We want to get some money into our kids' pockets. So they'll pay them somewhere between $5,000 and $10,000, not subject to Social Security, not subject to any income tax withholding. Child, if it's over $6,000 this year, they'll have to file a return. But even then, you're still better off, because I've had some that have paid them up to $10,000, $12,000. Kids are only in the 10% bracket. It may cost them $1,000 in tax at the most, probably not even. Maybe $500, $600. Mom and dad typically pay that too, in the situations where I've been. But they've shifted this $10,000 from a 25% bracket down to a 0 or a 10% bracket. So it's worth it to them, because they figure they're going to pay for school anyway, so they just will do it now and get some income tax benefits out of it. For anybody else, workers who perform services under your control, all cash wages paid are subject to Social Security and Medicare taxes. If you pay them more than $150 in cash wages for the year, or non-cash wages, $2,500 or more. The non-cash wages can be in the form of grain. You can pay people in grain. Basically what it does is it reduces your income, just because you pay them in the grain. W-2s and Form 943s are required. Now, if you start paying a lot of wages, there will be a few other requirements, quarterly estimate payments and that type of stuff. But for most of our people, they can pay the tax with the 943 at the end of the year. Commodity wages. Commodity wages are not subject to Social Security, federal income tax withholding, or federal unemployment tax. Basically, it's just like when you're paying a kid. You pay them in grain. You say it's this many bushels at this price. You recognize the income, but then you also get the wage deduction for the same amount, so it nets to 0 for you. And then the employee, and then you give them a W-2, but you're still not subject to any of the Social Security or Medicare or any of that type of stuff. The one comment that I will make on this is you've got to make sure you're playing the game if you do this. It has to be transferred to the employee. The employee has to take the risk in marketing the grain, selling the grain. Now, you can do it with cattle too. The IRS doesn't like it nearly as much with cattle, but you can do it. The employee takes the risk, and then if there's any gain or loss, that gets reported on their Schedule D as capital gain or capital loss. But that's probably the biggest warning with this, is if you're going to do it, it's a transfer of a certain bushel at a certain date. You can't haul it to the elevator and say, this load's Johnny's, send him the check. It doesn't work like that. The way this is set up is they take the responsibility for marketing that grain, selling that grain, paying any storage costs that may be associated with that grain. Now, they can rely on you for when to sell it, but they need to be the one pulling the trigger. So, Section 105 plans. What this is, and the best one out there that we really look at, is AgriPlan BizPlan. They run it for you. Basically, you sign up with them, you pay a fee, they tell you what you need to pay, they tell you how much is deductible, they give you a sheet, they stand behind it. But what it is the IRS allows for you to employ your spouse, pay them a wage for work performed, bookkeeping, cooking meals, helping in the field, whatever it is they're doing, helping vaccinate cattle, whatever it is they're doing. It has to be for work performed. You need to pay them a wage. Once you pay them a wage, you can also allow them to receive tax-free fringe benefits. These include health insurance premiums for the spouse and their family, which in turn includes you, and also out-of-pocket medical, vision, dental expenses. If you've got kids who are getting to the age where they need braces, or you just have a lot of medical expenses, that's where the benefit is at. Because then, instead of the health insurance premiums being a just income tax only deduction, you get deducted straight off the Schedule F for you and your spouse and your family. But then also you get to deduct all of your medical expenses, whereas if it were just a regular deduction, it's an itemized deduction that most people don't take because it's subject to it's got to be more than 7.5% of your AGI, which round numbers, if your adjusted gross income's $100,000, it's got to be more than $7,500 before you can even start deducting it. Where in this case, not only are you getting to take it off your farm income, so you're saving self-employment tax, you're also saving income tax on something that you wouldn't even be able to deduct normally. Now, the catch is, or the caveat is, you cannot discriminate. So if you are employing more than just your spouse or your children, you cannot do this and not pay their out-of-pocket medical, dental, vision as well. Now you can put caps on them, which is part of the reason for the agri-plan, because they can kind of help you cap that too. Typically it works best if you're only paying your spouse. If your spouse is not working off the farm, not subject to health insurance, or not eligible for health insurance anywhere else, that's where this works the best, because it can save you pretty good. Yes?
Do you have to be paying them a wage or anything over the year, or can
Write the check at the end of the year?
Well, no, but can you just say that they're working for benefits?
There has to be a wage paid.
Okay.
There has to be some sort of wage paid.
Okay.
It doesn't have to be much. Some of them I've seen, they're paying $2,500 in wages and giving $15,000 in benefits. That's where, for us, AgriPlan comes in, because they administer all of that. They tell you what the wage should be. Now the things that they'll recommend, they'll tell you that they recommend that you have a separate checking account for it, so that you write a check from you to the spouse that goes into a separate account. You don't have to, but they recommend it. The other things that they'll recommend is keeping a log, keeping some sort of hours records. And they'll also recommend that you pay them on a monthly basis or bi-weekly basis or something along that lines, just because you wouldn't go work for a job for my accounting firm and then just get paid once at the end of the year type of a thing. You're not going to work all year for free, basically. Now granted, I understand the benefits are what you're working for, but that's just their policies, their suggestions. And the reason they do that is they have fought some pretty big cases. There was a case that they just won here year and a half ago down in Kansas. The preparer had them use an AgriPlan. They were following the plan exactly like AgriPlan told them to. The IRS came in and disallowed the expense. They had gotten audited and the IRS disallowed the expense. And they weren't talking huge numbers, but it was a pretty good number. But if they would have just been them trying to defend it, they probably would have just paid it and gone on. AgriPlan backed it. AgriPlan paid for all of the litigation costs, and it was $100,000 to $150,000 in litigation costs that this cost them. But they did back it and they won. So if you're following what they tell you, that's probably the biggest benefit to AgriPlan. If you're doing what they tell you to do and you keep pretty good records, they'll back it up if you were ever get audited. So, but that's probably the biggest thing with that is, make sure you're paying the wage. It's for work performed, and then also you have to work with somebody to implement the plan. AgriPlan's fee really isn't that much. I think it's like $300 to $500, which really, if your deduction runs somewhere between $10,000 and $15,000, it's pretty good savings. It pays for itself pretty easily. So, leases versus purchases. Lease payments for real property or equipment is 100% deductible. If you're leasing a tractor and your payment's $25,000 a year, it's all deductible. You cannot deduct rent paid in crop shares if you deduct the cost of raising crops as a farm expense. Basically what that's saying is if you're putting on all the chemical, all the fertilizer, all the seed, and you're deducting all of those, you can't say my income was this, but I also had this in expenses, because that's the beauty of the crop share side of it, is you just don't report the part that's theirs. So, lease versus lease purchases or capital leases, they need to be capitalized and depreciated. The following, I believe it's 5 items there, indicate lease purchases. Portion of the payments applied to an equity interest every month. Titles transferred after the payments. A bargain purchase option, where that comes in is if you're leasing a tractor for 3 years, then you can buy it out for $10 type of a thing. Portion of the payments are designated as interest. That's why you'll see a lot of those places that if they're charging you a lease, it's more of a finance charge than interest, for that reason. The payments exceed the value of the asset. So what we had seen a lot of, and I don't know if I've got it on the next slide or not, I honestly cannot remember. Nope. What we had seen a lot of was Wells Fargo and Farm Credit were both doing lease options on buildings. They were doing 5 to 7 year leases on buildings, on pole sheds, on machine sheds, that type of stuff. The reason was they had written these leases with a bargain purchase buyout, but they had written them as a true lease that if you rented it for 5 years, made your last payment, and said, you know what, I don't want it, they had to come get it, which made the building basically worthless, which is how they were getting around it. What they were doing was they were accelerating they were allowing you to accelerate the depreciation basically of the cost of these buildings. You could write it off in 5 to 7 years versus 20. Now with the bonus depreciation over the last few years, they kind of gone by the wayside. Wells Fargo has backed away from them completely, I know that. But that was an option that was out there. I don't know if Farm Credit's still doing it or not, I don't know for sure. So, a few other expenses. You need to allocate between personal and business expenses. A lot of times where we'll see that allocation is spouses' vehicles. They may end up on the depreciation schedule at 35 to 50%, just because we know they're doing some farm work, even if they work in town and they don't do anything else other than run parts back and forth or run food out to the field every once in a while. We know there is some use of that. The other side of it is the allocation. The other way is utilities, phones, cell phones, internet, that type of stuff, water. We're taking out a personal use factor on all of that. Typically utilities, we run 75% of the total utilities as a deductible expense. That's just kind of our golden number. Some places do other numbers. The reason for that is typically we know there is some personal use, because typically people aren't running 2 separate meters. They're not running the house on a separate meter from the dryer bins and all that type of stuff. Sometimes they are, but typically they aren't. So that's what we do, and typically it's a conversation with you. You know, does this include the house? Is this just the meter to the bin type of thing? Some people farm and don't live on the farm, so then it is 100% because they're keeping the utilities expense somewhere else. So, and I think your guys' system does a pretty good job of splitting that already. So it's probably not as big an issue with you guys as it is with some other people. So repairs and maintenance. And this one's actually changing a little bit. There's been some new regulations on repairs and maintenance and capitalizing and depreciation. Right now, the way it's written is if it substantially prolongs the life of the property, if it increases its value, or it adapts it to a different use, it needs to be capitalized. That's going to change slightly. They have written some new rules that don't go into effect until 2014. However, they're kind of goofy and they're retroactive. So you have to go back and look at stuff 10 to 15 years to see if you've not capitalized some items that should have been. We're not completely into it yet, just because we've been dealing with all the other tax law changes that we haven't been forced to deal with this one yet. I know the very basics right now, but basically if any of these items happen, and there's a few others, if you don't, like for instance, if you go through your combine and replace, let's just say you're replacing belts, gears, that type of stuff. You have somebody go through your combine and completely overhaul your combine. It may cost you $20,000 to $25,000. but it may not be a capital item because it is true repairs. However, under the new rules, if you wouldn't do it more than twice in the useful life, which for a combine I believe is 10 years, it's considered the actual useful life by IRS standards. If you wouldn't do that more than once, basically, within that 10 years, it needs to be capitalized from now on. And it's just some goofy rules that they've come up with. So we'll talk about that more probably next year, just because it'll be more relevant next year. But it is something that's coming. The IRS has always been somewhat critical of repairs and maintenance. We typically try and go through and look and see if we can find anything that should possibly be capitalized. If you do go through and overhaul your combine, we may have the conversation. Maybe we should capitalize it. Right now it doesn't matter because we can write all of it off anyway. In the future that won't be the case. So, but that's kind of my spiel on repairs and maintenance. Real estate taxes, you should take out a portion for the home because typically real estate taxes, if you're living on the farm, if you're paying taxes on the whole place, it does include something for the house. A couple $100 probably covers it usually. Meals are 50% deductible, and this actually, that caveat to that, meals means if you're paying for somebody, neighbor comes and helps combine, you buy them supper, that's a deductible meal. If you've got to run to North Dakota to pick something up, if you buy something in North Dakota and you're driving up there to get it, the meals to do that is deductible. You just going uptown every day and eating is not a deductible meal expense. Groceries are not a deductible meal expense. There's people that try it every year, but those type of things are not deductible. So, what's that?
Well, you just slip them in there.
Yeah. If it's not a big number, people probably aren't going to look at it real close.
So the groceries can't be part of their wage
No.
staying benefits, right?
What's that?
That, back to that ag plan, biz plan, you couldn't include groceries as part of.
Nope, it's just medical, dental, and vision. Now, if you really want to play the game, you can form a C corporation, and then you can start deducting meals, groceries, health insurance, that type of stuff. You really do have to play the game then, though. The IRS did come back, and at one point we had 3 in our office, and we knew of 7 or 8 others around the state that were being audited. The IRS did end up backing off of it at this point, but that's what they were looking at, was the groceries, the health insurance, and the employee benefits. There really are some games you got to play. You got to have a full-time cook. It can be mom, but you got to be paying her a wage. It's got to be a fair wage, and she's got to be a full-time cook and that type of stuff. So, and then and you can actually, at that point, you can even deduct housing. You can build a house and deduct that as well. So, but you really do have to play the game at that point. So,
Well, those meals are only 50%.
Yes. Yep. So, items purchased for resale. The biggest one where we see this is probably hogs and cattle. If you're buying cattle and feeding them in the feedlot, obviously it's the cost needs to be in the year of the sale. So for some of my producers, they're buying in November and December. They emptied their lots and they're buying back in November and December. That expense does not count for 2012's tax return. We carry it into next year because you want to match up the sale, the cost with the sale. So, loan expenses, we don't see a whole lot of this, but they are supposed to be amortized over the life of the loan. Typically they're deducted as a bank expense, but the correct way to do it is if you've got a lot of loan expenses, you take out a big loan, you got $5,000 in loan expenses, it's a 15-year loan, you're supposed to amortize that $5,000 over 15 years. So, prepaids, this is probably the biggest way that people split shift, move their income. Prepaids need to be a purchase, not a deposit. With that, you need to specify a certain quantity of the item purchased. You don't have a right to a refund. It's not a deposit on the seller's book. You can't go to wheat growers and give them a $30,000 check and say, we'll figure out what it's for later. Just put this on my account. It needs to be for a specific item. You can't substitute other goods or services with it. Now, in that situation, there may be some leeway with that, just because, for instance, you go and buy nitrogen, you ended up not planting as much as you thought you were going to that needed nitrogen. That time, I mean, that works, but it can't be a loan or an accounts payable from the supplier either. It cannot be, you can't go into wheat growers again and say, I wanna buy 100 tons of urea or whatever, and say, just charge me, we'll figure it out later. That's not a prepaid. So, there must be a business purpose for it. Now that's pretty easy to define, determine. The most simple way to put it is we're trying to assure our supply. A couple years ago there was some fertilizer shortages. We want to make sure we're on the list. We want to make sure we've got ours. That type of thing. The other one is typically a price. Most places offer a end of the year discount. Now that one's getting a little bit harder to defend just because of the fact that a lot of places are starting to say you've got till the 10th of January to pay it. You're not necessarily avoiding an increase in price, but you may be because, you know, at planting time fertilizer may go up. So, yeah.
Right before the end of the year, you heard a commercial on the radio from some of our lovely seed suppliers around the state.
Okay.
That you could prepay your seed and for a certain amount or whatever. Come this spring, if you didn't get it all planted, that they would pay you back what you prepaid on plus 5% interest. Can they do that? And can they do that, or can you write it off?
I honestly don't know. Now I would say probably not, because one of the requirements to be a prepaid is you don't have a right to refund.
Right.
I think they're probably okay if they're saying you don't get it planted, we'll hold it, you know, we'll hold it or we'll refund your money type of thing. I think you're probably okay there. The 5% back is what would scare me.
Right.
Just because not only at that point have you said, well, I've got a refund, but you have no reason not to go in and buy it at a cheaper price later if it comes up cheaper and say you didn't plant it. But I guess from my standpoint, that's a gray area.
Well, the company likes to play the gray area.
Yeah.
You know what I'm talking about?
I think I do.
Okay.
Brothers from over by
Yeah,
Beersford, Baltic, that area. Yeah, I think it's a little bit of a gray area. Would I take the prepaid deduction? Probably, but we'd have a conversation, and you may get a letter that says we took it, but if you were to get this back, we may need to revisit this, or if you were to get looked at, you're on your own, type of a thing.